Hey everyone, and welcome right into today's explainer. We're tackling a genuinely fascinating paradox in the retail space right now. We're going to look at how severe macroeconomic headwinds, specifically the massive impact of international trade tariffs and domestic housing shifts, are really putting the squeeze on the home goods sector. But more importantly, we're going to look at how certain hyper-agile brands are actually using digital strategies to thrive right in the middle of this perfect storm. It's literally rewriting the retail rulebook in real time, so let's dive in. Here's our roadmap for this explainer. First, macro headwinds in home goods. Second, navigating the tariff threat. Third, housing market trends and shifts. Fourth, how Williams-Sonoma defies the odds. And finally, strategies for future growth. All right, kicking things off with Section 1, macro headwinds in home goods. You know, you look at a beautifully staged room and it looks incredibly serene, right? Well, behind the scenes of the furniture industry, a massive squeeze is actually happening. We are dealing with dual macroeconomic threats that are wreaking havoc on supply chains. I'm talking about rapidly shifting international trade policies on one hand and persistent inflation weighing heavily on the consumer's wallets on the other. To really anchor our understanding of consumer sentiment right now, consumer confidence actually dropped 5% year over year in September 2025. This was largely driven by inflation fears and, honestly, just a lot of apprehension around these new trade policies. Because think about it. When people are worried about the broader economy, big-ticket home furnishings are usually the very first purchases they delay. Nobody really feels like buying a brand new sofa when their weekly grocery bill is surging, right? Moving right along to Section 2, navigating the tariff threat. Now, this is where the math gets genuinely challenging. The escalating threat timeline here is pretty stark. In late 2025, a 25% global tariff was announced on key items, things like upholstered furniture and cabinets. By January 2026, those are scheduled to jump to 30% and 50%. But here's the absolute kicker. These duties are levied on top of existing tariffs. So we're talking about combined duties that could potentially tax Chinese cabinet imports up to a staggering 70% in 2026. For an industry that heavily relies on overseas manufacturing, that's a seismic shock to profit margins. So how's the industry reacting? Well, look at the sheer scale of the disruption. 90% of companies have delayed or canceled shipments. But what's really wild is that a massive 72% decided to just eat the cost increases themselves rather than pass the entire burden onto the consumer. Though, to be fair, 62% did eventually have to raise retail prices somewhat. And looking ahead, 60% are planning the incredibly complex logistical nightmare of shifting their manufacturing to other countries. That brings us to Section 3, housing market trends and shifts. International trade isn't the whole story, though. Domestically, the housing market is shifting, creating this totally split economic reality. On one side, lower-income families are feeling a severe squeeze. They're dealing with inflation, student loan payments coming back online, and it's leading to some real credit distress. However, on the other side, the broader consumer base is actually quite financially healthy, buoyed by low debt and rising real incomes. So there's absolutely still a massive pool of capital out there ready to be spent on home improvement. Retailers just have to know exactly how to target it. There is a pretty significant silver lining on the horizon for the industry, too. Thanks to a recent 57 basis point drop in mortgage rates, the 6-month home purchase intent has climbed back to a healthy 5.7% as of September 2025. This is absolutely critical because housing turnover is the ultimate engine for home goods sales. Like we said earlier, you buy a new house, you kind of need to buy a new dining table to go with it. Let's look at a real-world example in Section 4, Williams-Sonoma defies the odds. With all these massive global and domestic headwinds, the 70% potential tariffs, the highly fractured consumer base, you'd naturally expect retailers to be crumbling. But industry giant Williams-Sonoma isn't just surviving this storm, they are completely thriving in it. They recently posted record numbers for the year, pulling in an absolutely incredible 8.84 earnings per share for fiscal 2025. They even boosted their quarterly dividend by 15%. So the obvious question is, how on earth are they pulling this off in today's climate? Well, breaking this down across their portfolio gets pretty fascinating. Notice how the core Williams-Sonoma brand surged an impressive 7.2%, and West Elm grew by 4.8%. This diversified strength expertly offset a slight 2.3% dip they experienced over at Pottery. It's a perfect example of how a varied brand portfolio can absorb those localized market shocks. Now, this next point is just staggering. What makes their 20.3% Q4 operating margin so incredibly impressive is that they achieved it while absorbing roughly $80 million in incremental tariff costs directly into their merchandise inventory. Remember earlier when we talked about 72% of the industry being forced to eat these costs? Williams-Sonoma did exactly that to the tune of 80 million bucks and still delivered record profitability. And as CEO Laura Albert points out, this kind of structural resilience isn't an accident. It's built entirely on offering distinctive, in-house designed products that give them serious pricing power, combined with elite omnichannel execution. See, when you design your own unique products, you aren't racing to the bottom on price. That allows you to defend your margins even when supply chain costs spike out of nowhere. And that leads us to our final part. Section 5, Strategies for Future Growth. So how do they plan to keep this incredible momentum going into 2026 and beyond? They certainly aren't resting on their laurels. Look at their capital allocation for 2026. They have a $275 million budget, and they're pouring a massive 95% of it straight into e-commerce, retail tech, and supply chain efficiency. Actually, they expect their physical store count to remain basically flat this year. They clearly recognize that the battleground for the modern consumer isn't necessarily on Main Street anymore. It's in a digital shopping cart and the fulfillment center. Their blueprint for future growth is straightforward, but it's incredibly smart. Step 1, master the digital pivot. About 2/3 of their revenue already comes from e-commerce, so they're doubling down on maximizing that digital execution. Step 2, aggressively scale their emerging in-house brands. Take Rejuvenation, for example. They're seeing double-digit growth there, driven heavily by project-led categories like cabinet hardware and lighting. And Step 3, expand their lucrative business-to-business pipeline to target the underserved high-end furnishings market. Because of this extremely focused execution, they're confidently guiding for net revenue growth of anywhere from 2.7% up to 6.7% in 2026. And the crazy part about this guidance, it is incredibly conservative. It assumes current tariffs remain permanently baked in, and it factors in zero tariff refunds. They are literally planning for the absolute worst macro conditions and still projecting solid, profitable growth. So that leaves us with a pretty big question. As top-tier retailers completely rewrite the rulebook, relying on proprietary design, digital dominance, and highly agile supply chains to outmaneuver global tariffs and housing fluctuations, are we witnessing a permanent evolution in the home goods market? It certainly seems like the days of just opening a showroom and waiting for foot traffic are over for good. The resilient retailer of tomorrow is digital, diversified, and deeply data-driven. Thanks for joining me on this explainer. I hope this gave you a brand new perspective on the forces shaping the retail world today. Catch you next time.